Smart investing isn't about finding the next trend, taking big risks, or predicting the market. It's about discipline, patience, and understanding value. That's the core message of Benjamin Graham's timeless classic, The Intelligent Investor. If you enjoy videos that make finance simple and powerful, click the link in the description for more investing lessons and book breakdowns. Benjamin Graham is known as the father of value investing, and he was also the mentor of Warren Buffett. And Buffett calls this book the best book on investing ever written. So let's break down the key ideas. Graham explains that there are two types of investors: the defensive investor and the enterprising investor. The defensive investor plays it safe, investing in stable companies, diversifying, and ignoring market hype. The enterprising investor is more active, analyzing companies deeply and searching carefully for undervalued stocks. But no matter which type you are, the most important rule is this: don't speculate. Invest. Most people gamble without realizing it. They buy because of headlines, hype, influencers, or FOMO. But Graham teaches that an investor evaluates while a speculator reacts. To invest intelligently, you must focus on intrinsic value, the true worth of a company based on its performance, assets, earnings, and future potential. Not the price. Not the trend. Not the rumor. And this leads to one of the most famous lessons of the book, Mr. Market. Imagine the market as a person who offers to buy or sell stocks to you every day. Some days, Mr. Market is confident and prices are high. Other days, he's depressed and prices are low. Your job is not to obey his emotions, but to take advantage of them. If Mr. Market is fearful and sells good companies cheaply, that's your opportunity. If Mr. Market is euphoric and overpriced, that's your warning. Oh, if this is making investing feel clearer already, hit that subscribe button so you never miss powerful lessons like this. Another core principle is the margin of safety. This means you only invest when the price is far below the true value. It gives you protection if something goes wrong. Just like a bridge is built to hold more weight than expected, your investments should be chosen with room for error. Buy quality companies when they are undervalued. Not just cheap stocks, but strong businesses temporarily priced low due to market emotions. Graham also warns against reacting to short-term news. The market fluctuates daily, but value changes slowly over time. The intelligent investor is calm, consistent, and patient. As Graham famously wrote, "In the short run, the market is a voting machine. In the long run, it is a weighing machine." Meaning, short-term prices reflect popularity. Long-term results reflect reality. So focus on the long game. The final message of The Intelligent Investor is that investing is not meant to be exciting. It should be steady, thoughtful, and almost boring. If you want excitement, go to a casino. If you want wealth, invest patiently. You don't need to predict the future. You only need to buy wisely, hold patiently, and trust value over emotion. Okay, if this breakdown helped you understand investing more clearly, subscribe and share this video with someone who wants to build real wealth. Remember, wealth is not built by speed, but by discipline. Not by luck, but by understanding. Not by reacting, but by thinking. Be the intelligent investor, not the emotional one.